Looking at the current market uncertainties, where do you think the investors should really be placing their monies?
It depends on your time frame and risk horizon. Last 2 years, the underperformance of large cap has been very high.
What are the basic guidelines they must follow?
Don't put some money which you may need in case of emergency.
What makes you think that India will outperform from a long-term perspective?
India is growing fast in real GDP. Inflation is 4-5%. The stock market has not traded well. China, the economic priorities are very different. It's a centrally managed economy.
What are the sectors, what are the themes, what are the categories that they should really look at?
Multiple assets like gold or oil may do well. Korea correct 20-30% in the last couple of months. Discipline in asset allocation is the key to long-term wealth.
You have overseen more than 1.2 lakh crores in equity assets. How do you sleep at night? Everybody loves investing when the markets are breaking records. But how do you make money when the markets are volatile? I am Thomas Stephen, Director and Head, Preferred at Anand Rathi. Welcome to Funda, a brand new series where we are going to unpack the math behind wealth creation. Today we would be figuring out how market uncertainties can become massive opportunities with a man who has overseen more than 1.2 lakh crores of equities, Manish Gunwani, the CIO of Bandhan Mutual Fund. Manish, welcome to the show.
Thanks for having me.
You have overseen more than 1.2 lakh crores in equity assets. When these kind of monies rides on your daily decisions, how do you sleep at night?
It takes time getting used to. Initially, you do get much more nervous, but over time, you get used to it. And I think there are two parts to that answer. One is, as a fund manager, you're really thinking in terms of percentage of the portfolio, not so much the absolute amount. So you always think this stock is as a 3% of my portfolio. You don't think whether it's 100 crores or 300 crores, right? So that is how, as a fund manager, you work. But the other part is also that one of the motivations of being in the mutual fund industry is the kick you get by creating value for a lot of investors. The scale, the fact that retail investors are coming to your fund. And if you do well, they make money.
Absolutely.
That is one of the things that wakes you up in the morning.
Very, very nice. IIT Madras, IIM Bangalore. You could have gone on to build the next big tech company, Dalal Street. Why did you choose that?
Actually, I tried that also. So technology and finance have been my two big passions. And for almost 5-6 years, I was in a startup with a couple of my IIT batchmates. Unfortunately, that didn't scale up. It's still profitable, doing well. But it could not really scale up to a big level. So, in fact, I have alternated between finance and technology in early part of my career. But over time, I've realized that finance is probably a bit more luckier for me.
Very nice. Looking at the current market uncertainties, where do you think the investors should really be placing their monies?
So, I think it depends on your time frame and risk horizon. In general, structurally, we felt that among equities, the small cap space is the best space to be. If you have patience, if you can ride out the volatility, if you can think of 3 to 5 years, not just 6 months to 1 year, I do think that the small cap space is the best space to be, because I think there's a lot of change in the economy, a lot of change in geopolitics. And whenever there's a lot of change, the smaller companies, if you pick the right themes, they tend to produce higher returns than the incumbents. When the macro is very stable, then the large cap companies do well. So I think if you have 3 to 5 years, you should be in the small cap space. Having said that, near term, I am a bit more preferring the large cap space, primarily because I think over the last 2 years, the underperformance of large cap has been very high. And I'm quite hopeful that a lot of foreign investors who sold India will come back in the next few quarters. And what does tend to happen is when foreign flows come back, they tend to be more large cap centric and they tend to buy more large caps than mid and small caps. So maybe from a 6 month, 1 year perspective, large caps may do well. But as I said, if I have long term money, if I have patience, I would put my bet on a good small cap fund.
So for somebody young, somebody who has longer time frame for investment, we should look at probably small cap. And for somebody who's a little more older,
Yes,
somebody
yes,
who's in retirement or planning retirement, maybe from a small time frame, large caps looks better at this point.
Yes. Obviously, we cannot deny that small caps are a bit more volatile. Whenever there is a macro issue or liquidity stress, they will fall more than large caps. So yes, someone who's wanting more stable return, someone who's wanting more stable income, they should prefer large caps.
If someone is investing for the first time, what are the principles or what are the basic guidelines they must follow?
See, one is if you're coming to the market for the first time, I think it's very important for you to be clear about what is your risk profile. Because unfortunately, a lot of investors, when they come into the market, it's just because word of mouth and the market is going well, and there's a lot of hype around the market. And time and again, we've seen that they get disappointed and then they leave and never come back. So I think it's good and maybe it's useful to have a financial advisor as well. But if you're coming first time, in general, I think it's good to come through a hybrid product like balanced advantage fund or a multi-asset fund. If you think your risk profile is such that you can't tolerate too much volatility, because a full equity fund will obviously be more volatile. So I think the most important thing is have a sense of the time frame you're investing for. Don't put some money which you may need in case of emergency. So equity is obviously money which should not be kept for day-to-day expenses or kept as an emergency, because you don't want to sell when market is low. So you should ideally come to equities when you have money for 3 to 5 years, or at least 1 to 3 years. Anything below that, I don't think people should actually come to equities. So that I think is the most important thing.
So one should only get into investing into equities when they have a slightly longer time frame.
Yes, definitely.
India is the fastest growing economies amongst the major economies in the world. What makes you think that India will outperform from a long-term perspective? And how do you think that this short-term volatility that we are facing at this point in time will impact India?
See, generally we've seen over the last 25, 30 years, most countries, the corporate earning growth, if you take very long-term data point, let's say 10 years, 20 years, 30 years, then the corporate earning growth more or less exactly mirrors nominal GDP growth, not real GDP growth, because we live in a nominal world. So if India is growing fast in real GDP, inflation is 4-5%, typically we will expect India to grow at 11-12% nominal GDP growth over next 10 years. And generally corporate profit growth should mirror that. And that is obviously one of the highest rates in the world. So I do think that when you have fast nominal GDP growth, you will tend to outperform. Now, having said that, one should be careful. There are extreme examples like China, where the real GDP growth has been very high, but the stock market has not created wealth. But again, that is a bit of an outlier example, because China, the economic priorities are very different. It's a centrally managed economy. In most democracies, whenever a country has faster nominal GDP growth, corporate profits follow that, and markets ultimately follow corporate profits. In the near term, your price to earning multiple may range sometimes 17, sometimes 21. But when you take a 10, 15, 20-year horizon, then really more than the price earning multiple variation, which is not very much. If your corporate profits keep compounding 10, 15%, then your returns will be similar, which is a very healthy return. So I think the key to India's outperformance is the higher nominal GDP growth.
How significant is the FI inflows into India compared to 5 years or 10 years ago?
So clearly, what has happened is we've seen domestic flows scale up a lot in the last 10 years. So today, you could make a statement that domestic flows dominate the market. But having said that, a lot of people say FIs don't matter. I think that is also not true. They still own 15 or 20%, somewhere between that, of the market. And I think from a currency perspective also, their flows are important because India gets most of its flows in equity, not in debt. So for currency stability also, it is good to have foreign interests. Now, last 2-3 years, they've been very weak, partially because domestic flows were strong, because of which valuations have been expensive. But more importantly, because globally, earnings growth is strong because of AI primarily. And I think we are reaching a point where, as I said earlier, I'm quite hopeful next few quarters we will see foreign flows come back, because I do think a lot of these AI stocks, the valuations are a bit frothy. And I think it's a good point where, in general, globally, money will go back to more stable economies or sectors rather than these fast growing AI related stocks.
You've actually stolen my next question, which was about AI. So, how do you see the AI disruption? Because if we have also seen that over the last couple of years, there's a lot of FPIs and FIs who've started putting in money towards AI.
Yes.
In the US, in Korea, in Taiwan. So, do you think that this will really impact us as an economy? Or do you see that over a period of time, the same FPIs and FIs would start looking at India as an avenue for investments as well?
See, I think it's important to differentiate between the technology and the stocks. I think there's no doubt that AI is the most transformative technology we will see in our lifetime. I think it will touch every part of our lives. But whether AI stocks are good stocks to buy, that is a different debate. And my sense is, just like in internet, what happened in late 90s, the infrastructure stocks initially did well, like Cisco, WorldCom, whatever. So we've seen something similar where the chips and the memory stocks have done well. But a lot of them are actually commodities. Some part are obviously very high mode business, but some of these stocks are not very difficult to replicate. And I think the technology goes through a hype cycle, then the expectations come down, and then it becomes part of our daily lives. My sense is AI is maybe part of the hype cycle right now. At least the stocks are. And I do think that a lot of these memory stocks, for example, over 2-3 years, they are unlikely to give any high return. And we are already seeing fair amount of correction in these stocks. So I'm bullish on AI as a technology. I don't think we should be mistaken that just because the AI stocks are falling, that AI will not affect our lives. Obviously, AI will affect our lives. But I think the incremental wealth creation in AI will be on the application side, not so much on the infrastructure side. And in between, what may happen is a lot of the markets like India, which were punished because we did not have AI stocks, I have a feeling they will recover.
That's wonderful to know. If someone wants to construct a portfolio for the next 3 to 5 years, what are the sectors, what are the themes, what are the categories that they should really look at?
So I think I'm bullish on 2 or 3 different themes. One is, I think, manufacturing, because today when you see where India is in the development cycle, our services exports are very big, IT services and global capability center. Now the base is very high. I think for incremental job creation and to drive incremental export growth, it is very important for manufacturing to pick up. And I think the global situation is quite conducive in the sense that clearly the biggest manufacturing powerhouse is China. And I think China the currency is very undervalued at this point. So I do think yuan will appreciate against the dollar. And therefore, we will get a competitive advantage because of the currency. So from various angles, I think whether it is policy support, whether it's currency support, we have a big domestic market which helps a manufacturer scale up. So you can scale up for the domestic market and then export also. So there are a lot of advantages today for India to pick up its manufacturing game. And now manufacturing is obviously a lot of sectors. It could be auto ancillary, it could be chemicals, it could be pharma, it could be engineering goods. In particular, I think wherever there is some technology, some engineering, some medical input required. So I'm bullish on engineering exports, on pharma exports. That is one theme I think which may last for almost a decade kind of thing. The other is on the consumption side, I think a lot of the internet platforms will do well. Because one is obviously all the young consumers are more prone to using technology. And two is, in general, we are moving from low-end consumption of staples and very basic stuff to convenience and premium high-end brands, high-end apparel. So I think a lot of the internet platforms can appeal to this big youth population. And also, I feel that one of the key strengths of a management is going to be how they use AI and technology. And what happens is a lot of the old managements struggle to do that. Whereas the internet platform managements, I think they are bred in technology, so they can use AI better, I think. So I'm positive generally on these tech platforms as well.
So what you said is manufacturing, what you mentioned is consumption, and definitely AI is here to stay.
Yes.
When market uncertainties happen, a lot of investors stop their SIPs.
Yes.
Why do they do that? And what is the significance that it brings down to their overall wealth buildup that they would do over the next 10, 15, 20 years?
See, unfortunately, because equity, the prices are published every day, people get emotional about equities. If you think about it, if you own a house, you don't every day think this house is worth so much, right? Because there is no price of the house being published. So equities run on this greed and fear emotions. And whether it is, let's say, the Lehman crisis or COVID crisis, when markets fall 30, 40% in few months, it unnerves investors a lot. You had assumed net worth is 100, then you find your net worth is 60. And people then panic and sell, which is obviously the worst thing to do. So I think the key in equities is to be a bit more stable. Mentally, you have to be a bit more detached in one sense, very objective. And assume that volatility is part of life. Also, I think you should have ideally some model or some milepost to tell you where you are in the equity cycle. So, for example, you could look at a lot of our industry has balanced advantage fund models which show you how much equity they have versus debt. And that can probably, I'm not saying choose one company's model. If you can take 5, 7 and take an average, that may give you a good sense of where we are in the equity cycle. So I think investors should either have a financial advisor. That is one way to do it. If they want to do it themselves, try to follow some of these models, because you have to keep your emotion out. The fear and greed is what actually affects long-term returns. So I think that framework or some advisor is a good way to, tie yourself so that at that moment, in the heat of the moment, you don't panic.
So one of the things that I have understood from the conversation that we've had for some time now, is that wealth management or managing your money also depends on the advisor or the person who is actually helping you manage it.
I think it's very important for people to figure out how much time are they going to spend on their wealth management. And obviously, if you're working in an industry which is not related to finance, it's unlikely that you will have too much time. So I think it's then good to have an advisor. If you are willing to spend time, you can obviously research your own stocks, research models which tell you how much to invest in equities. So I think there's a spectrum. People who can spend no time should obviously go to advisor. People who can spend a lot of time can probably try, but I would think that just like we go to a doctor when we need medical advice, we can't be specialist in everything, right? And I think it's, for most people, I think it's good to have an advisor.
So me being in the financial services space, I still have an advisor because I travel quite a bit and there's lack of time.
Exactly. But it all depends what you're doing during the day. Even in financial services, like someone who's in corporate banking, he or she is not really spending time on investments, right? So there are very few people who are spending so much time on investments. And just like we go to a specialist for many things, for a lawyer, doctor, I think it's good to go to a financial advisor.
Should Indian investors consider international diversification? Because these days, a lot of clients are really wanting to invest, especially after the rupee depreciation.
Yes, I think obviously, again, depends on your needs. Like a lot of people today have children studying abroad and they need to fund that education. And if you think that 5 years, 10 years down the line, you need that, then it's good to have some asset in that currency, let's say dollar, for example. Two is, at times, periodically, Indian market tends to get overheated. We saw in October 24, and then for 2 years, broadly, the return has been zero at the market level. And I think multiple assets like gold or oil may do well during that time. So I think multi-asset funds are also a good option of diversifying your asset profile. So yes, I do think there is space for international investing. But again, what I get scared about is people who get swayed by momentum.
Absolutely.
Like today, if people are investing in Korea and Taiwan, I would
absolutely
please be careful. The market is already up 2x, 3x, whatever. So yeah, I just think that we should not invest in something we don't understand. It's good to take a very broad-based ETF approach then. Like if I have to diversify into global equities, I would probably look at an ETF or MSCI World, which has 1,600 companies. Just gives me broad exposure to the world equities. Or if you have time, if you are a specialist, then you do specific theme investing like gold miners or China or Brazil or whatever. But if you don't have time and you try to do it out of momentum because your friend or someone tells you, I think again that is the risk. We should not try to follow momentum in a lot of these markets because these markets can be very, very volatile, right? We've already seen Korea correct 20-30% in the last couple of months. So yes, I think have a long-term view, have assets at a very broad level, and just stick with it. I think based on whatever is your preference of, expenses or liabilities you have. I think that's the way one should approach it.
So let me put this question slightly differently. People across the world, they have this FOMO, fear of missing out.
Yes.
So there are a large chunk of investors today really wanting to invest because their friends have invested. But if somebody does not have their children abroad, somebody who does not really need to exchange the currency as well, would they also need to invest money in
No, it's fine. Even if you are not having any projected expense in dollars or outside. But still, as I said, in October 24, if you feel Indian market is a bit overheated, Indian currency could come under pressure, then gold or international equities can give you some protection. Also, sometimes, let's face it, some of these global themes like AI, they have created massive wealth. Now, only thing is, you try to get in early, which is not easy for a non-technical person, which is why I'm saying might as well be in a broad ETF of global equities or NASDAQ or whatever. So I think it makes sense even if you are fully in India, all your expenses are in India, because sometimes gold for extended periods of time does better than equities. Sometimes S&P 500, US equities may do better than domestic equities. So it's good. But again, the thing is, we are finally investing in things which we don't understand too much. So I do think it's good to have a broad-based theme approach rather than narrow themes. Like if you invest in a particular country like China, certainly politically something may happen. So you don't want to allocate too much money to riskier parts of the global assets, to my mind.
So diversification is the true sense that you should look at these investments.
Yes, because see, you are not a specialist. See, if you invest through an Indian mutual fund, we are frankly not specialists in S&P 500. So I think it's better to be very broad-based and diversified rather than pick individual AI stocks, because we really don't understand these specialist kind of subjects, right? So I would just say that have a long-term view. Don't get swayed by what people around you are doing. We saw when gold went to 5,000 for a month, and flows into gold and silver ETFs were more than equity ETFs, which is a very big red flag to my mind, right? So people got carried away with gold and silver price momentum, and then both have dropped 25-30%.
And they're still suffering for the push that they made.
Yes. So I think just have a slightly stable allocation to something you're just diversifying, right?
If you would leave one message to our viewers, what would that message be?
So I think asset allocation is the most important thing in life. Look, whether you invest in a large cap, flexi cap, etc., the return differences for most MFs are likely to be there, obviously, and that also you need to work on. Try to get a good fund manager, try to get a good AMC where you invest. But also, I think discipline in asset allocation is the key to long-term wealth. In general, at asset class level, I think it's better to be contrarian, right? Maybe in stocks, you can do momentum and all that. But when you're looking at asset classes like fixed income, gold, equities, real estate, it's good to have a bit of a contrarian approach, because whenever equities has done very well, see from COVID 2020 bottom to 2024, we had a great 5 years, lot of mid and small cap fund. The compounded annual return was almost 20, 25, 30%. At that point, you can probably think, okay, for 5 years, we made so much money, let's go to fixed income or let's go to gold or whatever. So, but again, I don't think if you're not a specialist, don't do it super actively that you destroy the returns of the asset class. So I think it's good to have a very disciplined asset allocation, depending on your risk profile, how much liquidity you need, can you keep the money for 10, 20 years, all those questions. And as I said, have a framework or an advisor. Your framework can be a simple model based on whatever price to earning, price to book, or historic returns or whatever, or go to advisor, because I do see a lot of people working very hard to create wealth or money, but they don't create wealth out of that money because they don't manage it well, right?
Absolutely.
I mean, a lot of people have fixed deposits, which is 60% of their net worth, sitting post-tax at 4-5%. It is just a suboptimal way to create wealth, right? So I do think that asset allocation is very important.
Manish, thank you so much for breaking down the reality of market cycles for us today.
Thanks.
It's a great reminder that staying disciplined often matters more than trying to tame the noise.
Yes.
Thank you so
Yes.
much. Thank you
Thanks
so
for
much.
having me.
To our listeners, if you want to keep refining your approach towards asset allocation, we are going to be bringing you these conversations to make you stay the course and take well-informed decision on your own terms. This is Thomas Stephen, and this was our first podcast of Fund Ka Funda with Manish Gunwani of Bandhan AMC. Stay tuned for the next one.
Anand Rathi Share and Stock Brokers Limited is mutual fund distributor. Mutual funds investments are subject to market risk. Please read all scheme-related documents carefully before investing.